Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. First, the stats. Last week, markets were mostly flat. But this week, the rally that started on April 9th continued. The stock market had a huge week with the S&P up 6.5% and NASDAQ up 7%. Pretty amazing. For the year, the S&P is up over 1% and NASDAQ is almost flat. Well, one thing you can say about President Trump is that things are never dull. The week began with monumental news. On the trade front, there was the beginning, and I emphasize beginning, of a deal with China. For 90 days, our tariffs were reduced technically to 10%, but there was a 20% charge related to fentanyl, which I believe means that the tariffs will be 30% across the board for China while negotiations occur. China, on the other hand, reduced its tariffs to 10%, and the talks will continue in a few weeks. As a result, on Monday, markets soared. And then there was even more big news on Monday. President Trump revived a very controversial policy that seeks to reduce drug costs that the U.S. government pays through programs like Medicare and Medicaid. The U.S. government will pay a price equivalent to what the lowest price drug companies charge elsewhere. Now, I have to say it was unclear how much less the government would pay and how broad-based this program would be, and would it apply to all drugs or just some? Details were incredibly sparse. But a more full announcement, we were told, would occur within 30 days. I am guessing that the pharmaceutical industry will fight this with every legal tool at its disposal. Interestingly, and I was kind of surprised by this, drug stocks were not down on this news, and I'm really not sure why. I guess investors don't believe that this new policy will have any effect or it may never go into effect. And that was just Monday. On Tuesday, President Trump was in Riyadh, Saudi Arabia, where he announced $600 billion of investments in the U.S. by Saudi Arabia. And then over the following days, he proceeded to go to Dubai and Abu Dhabi, where the size of the total investments in the U.S., we were told, reached an apparent $2 trillion. The president loves to do deals. On the negative front, and this is very company specific, UnitedHealthcare had terrible fundamental results. It also replaced its CEO. It suspended earnings guidance, citing, quote, unexpected medical cost challenges with its Medicare strategy. This is the second time in 2 months that UnitedHealthcare shocked Wall Street. But frankly, this is not new. The company has had trouble getting its arms around its medical costs for a while now, and this is not a problem that can be fixed overnight. The stock was down 18% on Tuesday and reached a level, get this, that the stock has not seen since November 2020. Like I said, this is a company-specific issue. I flag it because UNH has had a reputation as being a very well-run company for a long time. But that reputation has been damaged, and frankly, it's not clear why the company has messed up so badly. In a very light week for earnings, Cisco reported. Cisco provides tech and networking services. The stock rallied when it reported earnings, and I just point out that at $63, Cisco is back to where it was at the end of 2021. Why? During COVID, everyone went out and bought a laptop, and commerce rapidly shifted to e-commerce, meaning buying stuff online. And to accommodate that, companies bought a tremendous amount of equipment, like networking equipment, from people like Cisco to deal with this new business. There was such a huge pull forward for Cisco of its sales, and it's taken years to work through that. And Cisco's not alone here. Many other companies like Dell have been dealing with the same thing. That's why Cisco's first quarter earnings results were pretty impressive. It delivered a solid beat on earnings and revenue, showed strong growth in sales and AI-related orders, but even more traditional enterprise orders, which had been the company's problem, did okay. Walmart also reported. Earnings per share beat by 3 cents, but sales of $166 billion missed estimates by a tiny bit. It reaffirmed guidance, but warned that price increases were coming because of tariffs. Shocking. In other trade news, there was Apple. Apple makes almost all of its products in China. They are in a process of trying to move some of that production to India, but that will take years. But President Trump weighed in saying he does not want Apple to move production to India. He wants to move it to the US. Now, that might be completely impossible, but President Trump wants it anyway. An important piece of news hit Friday. 2 cable companies, Charter and Cox, announced a merger. And this has potential importance beyond this industry. Many investors bought the investment banks hoping that under President Trump, the IPO market and M&A would revive. And they have been terribly disappointed as the uncertainty surrounding tariffs has shut off IPOs and M&A. So maybe this is the start of the opening of M&A. We shall see. And that's the wrap. So let's turn to the mailbag. I've gotten a whole bunch of questions and comments, all revolving around one key theme. Could I put what has been happening into some kind of perspective? Here goes. First of all, this has not been a great earnings season. On the negative side, many companies pulled guidance because of economic uncertainty, and many, but not all, consumer-facing companies either missed earnings or revenue or reduced guidance. Tech was also a mixed quarter. Some companies like Meta did great, others not so much, but everyone was cautious. On the positive side, despite concern about consumer spending, consumer credit quality remains quite benign. So the quarter was not great, but it was better than some feared, and here is my point. Markets are not always rational. Why should they be? Markets are the sum total of decisions made by human beings, and sometimes we are rational, and sometimes we are emotional, and sometimes we're both. And in early April, when fears about tariffs were rampant, emotions ruled, and the market started to price in the worst case scenario immediately. And that's why the S&P was down 16% for the year on April 8th, and NASDAQ was down around 20%. And we've rallied hard since then. Why? Because investors got emotional and started to assume that the trade war was already here and a recession was looming. So they went into the quarter expecting the worst, and they did not get that. Also, we've had some good trade news, and so people are hopeful again. I would just warn that when it comes to trade, like in most things, the details matter. The U.S. is now negotiating with China over trade, and it's negotiating with many other countries as well, and we know almost no details. A lot can happen in the next couple of months. This is not over. So for long-term investors, I'd say that the U.S. economy is extremely dynamic, maybe more dynamic than ever. So long-term, things here are good, but a trade war would put us into a recession. So stay tuned. And finally, I've gotten a question about books. During the podcast I did with my former partners, Porter discussed how I made him read some books when he started working with me in 2002. I thought about it, and I realized that I gave him one of the books that I really liked by Judge Richard Posner. Judge Posner has written a crazy number of books, and I've read almost all of them. I consider him a mentor, and right after the crisis, we actually became friendly. So I'd recommend starting with one of his older books, Overcoming Law. And also, for those of you who are interested in antitrust, I'd read his antitrust book. Its importance, I can't overstate it, because antitrust law is today what it is because of that book. Speaking of Porter, I interviewed his brother Dwight this week. We discussed the full range of financial services, from investment banks to asset managers, to payment companies, to specialty finance and insurance. That podcast will drop Monday, so check it out. And see you again on the next episode of the Eisman Playbook. Thank you so much for tuning in. For video episodes of this podcast, head over to our YouTube channel. If you're listening on a podcast platform, make sure to follow the show so you never miss a new episode. And if you got something out of today's conversation, we'd love for you to leave us a 5-star review. It helps us reach more listeners just like you. For links to our website, social media, and to sign up for our newsletter, please check out the show notes of today's episode. On that note, I'm Steve Eisman. I'll see you on our next episode. A quick disclaimer, nothing on this podcast should be considered an investment or investment advice. Guests and their hosts may have positions in any of the stocks mentioned in this podcast. Please do your own work and consult an investment advisor. This podcast is produced by Collier Landry for Don't Touch My Radio and Steve Cohn for Next Horizon Media. Copyright Steve Eisman, Farseer LLC.